Close your eyes and picture a government printing money. Big machines, ink, paper. That image is comforting because it suggests control. Now here's the uncomfortable truth. Most money today is created without printing anything at all. No paper, no ink, just numbers appearing quietly on screens. And once you see how it actually happens, you'll never look at money the same way again. Because this isn't a loophole, it's the system. Right now, as you're watching this, new money is being created somewhere in the world. Not by governments smashing the print button, but by banks, loans, and promises. And that matters more today than almost any other time in modern history. Inflation shocks, housing bubbles, rising debt, fragile banks, they all trace back to this one invisible mechanism. So let's slow this down, strip away the jargon, and rebuild the story from the ground up. Start with a simple question. What is money? Most people think money is cash, notes, coins, something physical. But in most developed economies, cash is tiny, usually less than 10% of all money. The rest? Digital entries in bank accounts, numbers in databases. Which leads to a strange realization. If money is mostly numbers, who types them in? Here's the twist. It's not the government. It's not the central bank. It's commercial banks. The same banks where people take mortgages, car loans, and business loans. Let's tell this as a story. Imagine you walk into a bank to take a loan for a house. You're approved for 50 lakh rupees, or $300,000, or whatever fits your world. What do you think happens next? Most people imagine the bank going to a vault, counting cash, or moving money from someone else's savings to your account. That's not what happens. The bank simply opens its computer and types numbers into your account. Your balance jumps. New money exists, not transferred, created. This isn't a metaphor, this is accounting. On one side of the bank's balance sheet, they write, loan asset, 50 lakh. On the other side, they write, deposit liability, 50 lakh. Perfectly balanced, and suddenly the money supply just grew. No printing press required. This is the core mechanism of modern money creation, and it's both elegant and unsettling, because it means money is born from debt. Every time someone takes a loan, money expands. Every time a loan is paid back, money shrinks. Money doesn't exist first and then get lent out. It's created because it's lent out, which flips the usual story completely upside down. This system didn't appear by accident. It evolved slowly. In the early days, banks actually did lend out deposits, goldsmiths, vaults, paper claims. But over time, governments realized something important. If banks were forced to only lend existing money, growth would be slow, painfully slow. So modern economies made a trade. They allowed banks to create money through lending in exchange for regulation, supervision, and central bank control. In theory, it was brilliant. More loans meant more investment, more businesses, more homes, more jobs. And for decades, it worked remarkably well. But there's a catch. There's always a catch. Because the system only works if debt keeps growing. Think about it. When a bank creates 50 lakh through a loan, it expects more than 50 lakh back, interest. But where does the interest money come from? It isn't created with the original loan, which means the system quietly depends on future loans, new debt, new money, to pay interest on old debt. This doesn't mean it's a scam, but it does mean it's fragile. It needs confidence, growth, and time. Now let's bring in the central bank, because this is where confusion usually explodes. People say, the central bank prints money. Sometimes, yes, but most of the time it doesn't create money the way banks do. Central banks create base money, reserves, the plumbing of the financial system. Banks need reserves to settle payments between themselves, to meet regulations, to appear stable. But reserves don't automatically turn into money in your pocket. A central bank could flood the system with reserves, and if banks don't want to lend, nothing happens. That's what shocked the world after the 2008 crisis. Central banks created trillions, yet inflation stayed low for years. Why? Because banks weren't lending aggressively, and people weren't borrowing. Money creation stalled, which revealed something quietly terrifying. Central banks don't fully control money. They influence it, but commercial banks decide whether it actually grows. And what makes banks lend? Confidence, profit, low risk, which means money creation is deeply emotional. It expands during optimism and collapses during fear. This is why booms and busts feel so violent. During a boom, banks loosen standards, loans flow easily, money multiplies, asset prices soar. Everyone feels richer. Then something cracks. Defaults rise, banks pull back, loans stop, money disappears. Not physically, digitally. Balances shrink, credit lines vanish, liquidity dries up. And suddenly, everyone is confused. Where did the money go? It was never solid to begin with. This also explains why governments panic during crises. Because when private money creation breaks down, the entire economy freezes. So governments step in, guarantees, stimulus, bailouts. Not because they love banks, but because the system is built on them. Now here's where the irony gets sharper. Most people blame inflation on money printing, but inflation often comes from where money is created, not just how much. If new money flows into factories, logistics, productivity, wages, prices stay stable. Supply grows with demand. But if new money flows into housing, stocks, or land, prices explode. And that's what we've seen repeatedly. Money created through loans doesn't go evenly into the economy. It follows incentives. And banks prefer collateral, which means property, large corporations, financial assets, not risky innovation, not small businesses, not wages. So even when inflation looks low on paper, asset prices quietly inflate. Homes become unreachable, stocks detach from reality, inequality widens, and people feel like the system is rigged. Because in a way, it is. Not by conspiracy, by structure. Now zoom out further. This system also explains why debt levels look insane. Governments owing trillions, corporations leveraged to the edge, households buried in loans. Yet the system keeps moving. Because debt isn't a side effect, it's the fuel. Trying to remove debt from the system entirely would collapse the money supply. Which is why everyone should just pay off all debt sounds good and is mathematically impossible at scale. Someone's debt is someone else's money. Erase one, you shrink the other. This also explains why rising interest rates feel like a shock. Higher rates don't just slow spending, they slow money creation itself. Fewer loans, tighter credit, less new money. Which is why central banks raise rates carefully. Too fast and money collapses. Too slow and inflation runs wild. They're not steering a car, they're balancing a glass tower in an earthquake. And here's the quiet punchline. The system works until it doesn't. It assumes trust, that loans will be repaid, that growth continues, that tomorrow is bigger than today. But when trust breaks, money vanishes faster than it was created. That's why financial crises feel so sudden, because the money was always conditional.
a promise, backed by another promise, backed by confidence. So the next time you hear money printing, remember this. The most powerful money machine in the world doesn't print anything, it types. And the people operating it aren't politicians giving speeches, they're bankers approving loans and borrowers signing contracts. Which leaves us with one final uncomfortable question. If money is created by debt, and debt depends on belief in the future, what happens when the future feels smaller than the past? Because that's the question quietly haunting the global economy right now.